Look at the headlines today, and you might think the global economy just dodged a bullet. Whispers of a diplomatic off-ramp in the US-Iran conflict have Wall Street popping champagne. But if you actually drive down the street and try to fill up your car, you are experiencing a very different reality. For the first time since the immediate aftermath of the 2022 Russian invasion of Ukraine, the national average for a gallon of gas in the US has crossed the $4 mark. So if energy costs are actively crushing consumer wallet, main Wall Street indices just jumped more than 1% at the opening bell. Part of the answer is a market mechanic called short covering. When investors short a stock, they are placing a bet that its price will fall. But if headlines hint at peace and prices start to tick up instead, those same investors have to rush in and buy those stocks to avoid massive losses. That panic buying creates an artificial surge, driving the market even higher. Meanwhile, the Federal Reserve seems perfectly comfortable looking at the paper gains rather than the physical pain. Jerome Powell recently stated that Fed officials feel monetary policy is in a, quote, good place. But you cannot run a global supply chain on a stock chart. As long as the Strait of Hormuz remains physically blocked by conflict, this market rally is completely detached from the physical limits of the global economy. If you want to know what is actually happening out there, you have to ignore the stock ticker. The true barometer for geopolitical risk is the price of a physical barrel of crude oil. Let's look at Brent North Sea crude. Oil is traded using futures contracts, agreements to buy oil at a set price for delivery in a specific month. Comparing these different monthly contracts gives us a real-time map of global panic. This graph shows how those contracts are pricing the crisis right now. The line here represents the June delivery contract, which dipped 0.2% to around $107 a barrel. Buyers looking a month or two out are placing bets, but these diplomatic off-ramps might actually work. But look at this second line. This is the May contract, which expires on Tuesday. This contract represents oil that needs to be delivered immediately, and it surged 5.1% to hit $118.49 a barrel. That massive gap between the two lines is what raw panic looks like. Politicians can make promises about June, but the people who need fuel today are scrambling to secure whatever actual oil they can get their hands on. The entire global system is choking because a single, incredibly narrow waterway, the Strait of Hormuz, is currently impassable. And when the Strait of Hormuz is clogged, the global economy hits a brick wall. Roughly a fifth of the world's daily oil consumption flows through that one tight passage. Right now, maritime analysts point to Asia as the region staring down a major energy crisis. They are positioned to suffer the absolute worst of the immediate supply chain fallout. Adding to the chaos, U.S. President Donald Trump told fuel-starved nations that they should, quote, go get your own oil in the Strait of Hormuz. What started as a localized military blockade has rapidly mutated into a fragmented, every nation for itself scramble for basic resources. The immediate shock of a supply shortage is painful, but the real threat to the global economy is what analysts call the bleed. The longer energy costs stay elevated, the more they drag down profit margins, stall consumption, and suffocate growth. We are already seeing the hard evidence of this bleed in Europe. Because of the surging energy costs caused by the conflict, Eurozone inflation just jumped from 1.9% in February to 2.5% in March. That is the highest level we've seen since January of 2025. All of this is happening while the market is supposedly optimistic about peace. But if those talks fail and we see a U.S. ground operation or direct Iranian retaliation, that optimism will evaporate instantly. Market experts warn that if military forces escalate the conflict further, oil prices could easily hit $150 a barrel. We have not seen levels like that since July of 2008. So while traders in New York might be bidding up stocks on the rumor of a diplomatic off-ramp, the physical data tells a completely different story. Until crude is flowing freely through the strait again, the market's celebration is a mirage, masking an impending economic disaster. To navigate this market, you have to look past the optimistic headlines and understand the physical mechanics driving the numbers. If you want to see the forces actually shaping the global economy, make sure to hit subscribe and stick with us.